Hey everyone, welcome to my channel where we'll talk about different sectors and companies which are poised for future growth. So today we'll talk about CDMO, Contract Development and Manufacturing Organization. In simple terms, it's a company that helps big pharma develop and manufacture new drugs from research and clinical trials to large scale production. Instead of making their own drugs, CDMOs act like behind the scenes partners, handling chemistry, formulations, production work for global innovators. And they usually earn higher margins because it's a more specialized and value added business. So today we are talking about Aarti Pharmaceutical, a company that's quietly transforming itself from traditional API to chemical manufacturer into specialized CDMO player. Currently, the CDMO segment is up only about 13% of total revenue, but the management expects it to grow rapidly at around 30 to 35% CAGR over the next few years. And that's exactly why the business is worth studying. Because as the high margin CDMO segment business expands, it could drive a significant improvement in the company's overall profitability. Basically, Aarti has three core business segments. One is Xanthine business, the other is API intermediary business, and the third one is CDMO segments. So the benefit of talking about this stock is they have large capex projects that are in motion, especially in the API and xanthine divisions, which are expected to go live by the end of FY26 with benefits kicking in from FY27 onwards. So compared to peers like Newland, Bluejet, and Divi's laboratories, Aarti currently trades at a valuation discounted because CDMO is a very small percentage of its total revenue. But as the segment scales up, valuations could re-rate upward. All right, so let's talk about deep dive into each businesses. So Aarti's first business segment is Xanthine. Business segment might seem very dull, but it actually makes up more than 40% of Aarti's revenue. Xanthine derivatives like caffeine are used in energy drinks, soft drinks, and nutraceuticals. Aarti currently controls 15% of global capacity and is expanding from 5,000 tons to 9,000 tons by end of FY26, which could take the market share to more than 20-25%. The company is very well backward integrated as well to reduce the dependence on Chinese imports, which is a big plus for this company. However, Chinese dumping caused xanthine prices to drop in recent quarters, but the management believes that the prices have bottomed out and now should stabilize or recover. Since the segment nearly contributes half of the revenue, price recovery is very critical for the margins. Aarti is also shifting its focus toward regulated pharma and nutraceutical markets, which are less price sensitive and offer better profitability. Key things to watch in this segment is global xanthine price trends and utilization of new xanthine capacity, which will be fully benefited by the end of FY27. So let's talk about the next segment, which is API and intermediary segment. The division that also contributes nearly 40% of the total revenue of Aarti. Aarti manufactures about 60 APIs and 100 intermediaries, serving both generic and patented product markets. Generic API, while have very low margins, and patented or niche product command higher margins. Aarti target API priced is above 100 per kg, $100 per kg, and focuses on molecules that will go off patent in 3 to 4 years so that they can capture market share easily. So core therapy includes oncology and anti-hypertensiveness. Both are high value products. So there's a greenfly field API plant also, which is being commissioned in Atali, Gujarat, which has started operations in Q2 FY26, and it will ramp up through FY27, driving growth and margin expansion. Backward integration has also reduced reliance on China, improving cost control and raw material security. And the company's focus on regulated market, USA, EU, and Japan, helps maintain better margins and customer stickiness. So the next segment, which is the key growth driver of Aarti Pharma Labs, is CDMO. CDMO is currently contributes only 13% of the revenue, but it's the most exciting part of Aarti's future. Aarti focuses on phase 3 trials for innovative pharma companies, where order size are very large and the chances of commercialization are on the higher side. Peer CDMO businesses enjoy 50% of gross margins like Newland and other CDMO companies, and Aarti could move towards that range as this segment scales up. Management expects that 30-35% CAGR is achievable in the CDMO segment. As the CDMO share grows from 13% to potentially 13%, overall margins and valuation should also improve substantially. Of course, execution is the key risk. Delays, client concentration, regulatory hurdles could also slow progress. But if managed well, CDMO could be the game changer for Aarti Pharmalabs. Now, let's talk about the financials and quarter 2 FY26 update. So let's look at the numbers. Let's talk about the positives first. So the standalone revenue grew at 10.6% year on year to 417 crores of revenue this quarter. The Xanthine segment operated at higher capacity with a better beverage mix, which has supported margins. The Atali Greenfield site was also commissioned in quarter 2 FY26, marking a key milestone for future API CDMO growth for Aarti Pharma. However, quarter 2 FY26 raised a lot of concerns, which are short term. We'll talk about it and we'll get to know better what were the concerns. So the consolidated PAT fell more than 50%, and the EBITDA margin compressed to 17.7% from 25.4% last quarter. The finance cost almost doubled to 407 crores, and the total debt rose significantly to 5880 crores. While the company also missed its H1 standalone EBITDA growth guidance, actual growth was mere 0.4% versus the guidance of 12 to 15%. Nonetheless, the new capacities like the Atali plant added finance and depreciation costs, but the revenue benefits haven't kicked in yet. This is why there was a substantial fall in the PAT and EBITDA margins, because the revenue generation from the Atali plant has not started, whereas there was a higher cost, short-term cost higher from finance and depreciation cost for the capex. This resulted in a near-term execution pressure, even though long-term strategic investments remains on track. So short-term margins might stay under pressure, but long-term, once utilization improves by FY27, margin should expand again. Now, key risks. There's a future outlook of the Aarti, as you can see that a lot of sites has been increased. The reactor capacity will grow from 1100 to 11 to 1500. The CDMO revenue is expected to grow by 30 to 40%. The EBITDA is also expected to grow by 8 to 12%. And the Xanthine capacity specifically is expected to rise from 5000 MTPA to 9000. So now let's talk about the capital expenditure outlook. So there are two capex which is presently Aarti is doing. One is greenfield capex Atali project, which will ramp up by quarter 4 FY26, and the other brownfield capex which is Tarapur, Maharashtra. So now the key risks and monitoring points which one should look at while studying Aarti Pharma. One is xanthine pricing risk. If Chinese dumping continues, margin will remain under pressure, which can again put the stock down. Then the capex execution risks. The delays at Atali plant on new xanthine facilities could also push back revenue. CDMO execution, client wins, regulatory approvals, and project delivery timelines are also very crucial. So, in conclusion, Aarti Pharma Lab is a three-engine story. The xanthine business, mature but recovering. The API intermediary segment, stable and expanding. The CDMO division, small but with a high growth bet. Now, short-term earnings may stay muted because of higher costs from new plants, but over the next couple of years, as these capacities ramp up and CDMO scales, margins and returns should also improve. So the question is, can Aarti Pharma execute smoothly through FY26 and FY27? If yes, the valuation gap with peers could close rapidly. If you enjoyed the breakdown, hit the like button, subscribe for more deep dives, and let me know in the comments which segment do you think will drive Aarti's future.